Good morning and welcome everyone to today's webinar. This is the second of our webinars this year, which is our annual update to provide you with the latest information and insights that you'll need to prepare your financial statements for this coming financial year. And this year we're also giving you a bit of information and insight into ESG compliance, which has certainly gained a lot of traction in the last 12 months in particular. My name is David Francis. I'll be the host of today's webinar and also moderating the questions that you can ask through the Q&A box that should be on your screen. I'm the chair of the Bentleys National Audit Group and also an audit partner in the Adelaide office of Bentleys. Our speakers today are Carmen Ridley, who has spoken on behalf of Bentleys in relation to financial reporting matters for the last few years. Carmen is Principal and Director of Australian Financial Reporting Solutions and also National Technical Consultant to Bentleys and our clients, and also a former board member of the AASB, and so has some terrific insights into the discussions that have occurred around accounting standards. Our other speaker today is Emma Peters, Special Counsel with Cowell Clarke Commercial Lawyers, and I'll talk a little bit more about Emma when I introduce her after Carmen's presentation. For our guests today who are new to Bentleys, Bentleys is a network of advisory and accounting firms. We work with aspirational businesses and individuals to help them achieve their objectives and to get where they want to be. We have offices across Australia, New Zealand, and also in China. We offer the core services such as audit, tax and accounting, as well as an expanding range of specialisations to support the needs of a modern business. This includes things such as ESG compliance and business assurance, R&D tax incentives, superannuation, wealth management and HR advisory. We're delighted that you're able to join us today. Some housekeeping matters. We are using Microsoft Live event technology, which gives you the opportunity to ask the questions through the Q&A box, and I'll be sort of posing them to Carmen and Emma throughout the session. So if you would like to ask a question, please type it in there and I'll relay it. This session will be recorded and we will distribute the recording along with the slides after the presentation. I hope you enjoy today's presentation, and I'll pass over to Carmen.
Thank you, David, and welcome everybody to this session. So as David mentioned, my role today is to talk through financial reporting, give you a little bit of an insight on what has been happening, some things for your to-do list, which I'm sure doesn't need to be any longer, but I am going to add to that. So as David mentioned, we're really hoping this session can be as interactive as possible. So please use the Q&A box. You have got myself and David and then Emma a little bit later on that you can ask lots of questions too. So try and use our expertise while we are here. So let's get started. Just a normal disclaimer, this is obviously for training purposes only, and whilst I've just encouraged you very strongly to ask questions, I'm happy to answer those, but bear in mind that I won't have read any agreements, etc. So it is just a high-level advice. So the plan for today, the way I thought I would structure the session, is to have a little bit of a look backwards. Now, you'll be pleased to know I am not going to go through the revenue, the leases, the financial instrument standards again. We have been there previous years, we have done that. Whilst I don't necessarily think that those standards have still been implemented correctly in many organisations, we're not going to rehash that today. So we're going to look back at the last 12 months and see what's been happening. We're then going to have a look at now, what should be our priority? What do we need to be thinking about for our 30 June 22? And we're going to pick up a focus area and some contemporary topics. Then I'm going to look at what should be happening in your future, what should be on your future radar. So things that might be effective for June 23, or things that I'm seeing that I'm getting a lot of questions on that I feel that you may need to be aware of, or it may certainly pop up on your radar over the next 6 to 12 months. So that's the way we're going to work through the session for the next hour and 15, 20 minutes or so. So let's start with our look back. what has happened over the last 12 months? The first thing that we are going to focus on is our ASIC restatements. So ASIC being our corporate regulator. Even if you're listening and you are not regulated by ASIC, please don't think you should switch off on this bit, because we have quite an active corporate regulator who reviews a number of financial statements that generally they're listed, sometimes they drop below the listed. But what effectively these guys are telling us, and we'll see that in the focus areas that we see, is they're telling us that these are the areas they are finding the biggest mistakes in. Now, remember, regardless of what type of entity you are, you follow the same accounting standards. So even though these might be in a listed space, it's exactly the same issues that a not-for-profit faces or a smaller proprietary company who are producing financial statements. So what I want to do is talk through each of these to give you a little bit of an oversight on what's happened and give you some key messages from each of them. The weird little numbers that I've got after the names are the media release references. So if you are particularly interested in any of these, please feel free to look up that media release on the ASIC website and you'll get a little bit more information from them. So the first one is impairment. Now, it shouldn't be a surprise to any of you to know that impairment is the area that ASIC have got the most restatements. Generally, it is every time we look at this on a yearly basis or a half-yearly basis. Couple of different areas, however, that they're focused on here. So the first one relates to deferred tax. Now, we often forget that deferred tax assets is covered by the impairment standard. When we think about impairment, we think about property, plant, equipment, intangibles, goodwill. Deferred tax is one of those things that we also need to consider. So the criteria to recognise deferred tax assets is if you believe it is probable that you are going to utilise that in the foreseeable future. That's not defined, it's a judgment call. So you may a few years ago believe that everything was going great for you and you thought it was appropriate to start recognising your deferred tax assets. However, COVID hit, and depends on where you are in Australia, it may have hit you very differently compared to somebody else who is listening to this. So your results haven't been as great as you thought they were going to be over the last couple of years. Anybody who has deferred tax assets recognised on their balance sheet, please make sure that you are reviewing that and making sure that you have documented whether it is still appropriate for you to recognise those deferred tax assets. It is certainly on ASIC's radar, and it should be on your auditor's radars when they come out to start looking at this. The next one is in relation to intangibles, which is common. We see this quite a lot. This one in particular, it was around the optimism, shall we say, of their revenue assumptions. So the budgets that they had included for revenue were prima facie very, very high. And ASIC have come in and said, probably not appropriate, probably needs to be more reflective of where the general economic forecasts are going. So because of that revision of the forecasts, we've seen an impairment of their intangibles. So my key message from this one is please make sure that whatever inputs and assumptions you use to estimate cash flows, for example, for your recoverable amount, make sense and are supportable. Nobody knows your business as well as you do, but just make sure that whatever you are using has some reasonable basis, and it's not just this is the number we have to put in order for us not to have an impairment. The last one is an interesting one in respect of whenever I present on impairment, I always talk about reversals, and I say that it's in the standard. We never see impairment reversals, but this is what the standard requires. We've had an organisation here, so Oliver's Real Food. So those of you who are in Victoria, I don't know if they're in other states, but they're definitely in Victoria, would be aware that on a number of the service stations on motorways, we have Oliver's Real Food. So it's kind of the whole healthy alternative to your fast food places. Obviously, over the last couple of years in Victoria, we had much less traffic on the roads because we were in lockdown for most of the 2-year period. So these guys a couple of years ago, impaired their stores because they said, we're not getting the traffic through. We can't support these discounted cash flows. And then in their last financial report, they decided that actually things were much better now. And therefore that impairment that they'd put through, they reversed it. ASIC came in and said too soon. We don't have the evidence. We don't have the support. We actually think you're far too early on reversing an impairment. So what ASIC made them do was reverse the reversal. So what has ended up is these guys still have their impairment expense. They did put a reversal through, which was a credit to the income statement, and then had to pull it back out again. So my key message from this is, if you have done impairments over the last few years and you think that you're starting to pick back up again, just think very carefully about the timing of reversing those impairments. Remember, if you have if you've impaired goodwill, you can never reverse that. So any reversal will be on any assets except for goodwill. The next one relates to provisions. Now, this one we've seen happening probably more than we have over the last 12 to 18 months. So this is the last one of these that ASIC have raised. We saw last year that they raised lease make good provisions for a couple of retail companies. And this is a similar theme. So it's around that rehabilitation, it's around make good, it's around restoration. Anytime that we have to either restore something, rehabilitate something, fix up something that we've done, we need to make sure that we've got a provision. Now, what we're starting to see is a lot of discussion about how green an organisation is and how they're not going to do any harm. And there's lots of discussions around this and lots of published policies. One of the things that we need to think about is in respect of a constructive obligation for provisions. So Emma's going to talk to us later about sustainability and about some of these things that possibly entities have committed to do. But if you have set yourself up that there could be a constructive obligation and a past event has happened, which means that you now have an obligation, it may not be a legal obligation, but a constructive obligation to do that, you might have to fix it up. You may need a provision. This one to do with Woodside was to do with oil rigs. So it was very specific. Most of you listening probably aren't in the business of running oil rigs, but think about your leases, because probably over 95% of leases that I review have some sort of make good clause in them, which involves ripping things out or repainting or replacing carpets. Anytime we have to fix something up, we need to have a provision in place. So within my other section, we have the old favourite that pops up every couple of years or so, and that's to do with the classification of our liabilities between current and non-current. Obviously, it is attractive to have our liabilities as non-current. It's much better for bank covenants. It's much better, it makes a healthier balance sheet. But we can only show our liabilities as non-current if we have a right to defer that settlement for at least 12 months. If we don't have that right, then that liability has to be classified as current. And that was the situation here. This particular entity was told to change the classification of certain liability from non-current to current. So that's the restatements that we've had. I suspect there will be more coming, but that's what we've had in the last 12 months. So let's have a look and see what else ASIC have been up to. Last year, we had a very similar media release to this. However, the amounts in most cases were much smaller. So I wanted to include this just to again raise your awareness that ASIC are tracking whether we have lodged financial reports. From what I understand, there is much more communication, not necessarily people communication, but computer communication between ASIC and the ATO systems. So consequently, if you've lodged a tax return that shows that prima facie, you are a large proprietary limited, ASIC have the ability to potentially see that information, and therefore they can then go back to the entities and ask, why haven't we had your financial reports? Have you held an annual general meeting? As you can see from this chart, there is a huge variation in what people have been fined. Now, I don't know why some people have been let off with a 36-month good behaviour bond and others have been fined $300,000. There is a massive variation. What I want my key message for this is two things, two key messages I've got. Firstly, make sure you understand your reporting obligations. If you are required to lodge with ASIC, you need to lodge, or you need to be aware that there are penalties if you don't. The second key message, and we're going to talk a little bit later on about moving certain entities who will have to move from special purpose to general purpose. In assessing whether you are a large proprietary in particular, you are supposed to apply all the recognition and measurement criteria within the standards to make that assessment. What I'm discovering is as many entities now are moving from that special purpose to general purpose and having to apply all the standards. I have had probably 10 queries from entities telling me that they are now large, and they probably have been large, in particular since the leasing standard came out. And they haven't lodged because they didn't apply the accounting standards, so they didn't realise that they were large. So just be aware that if you're having to move from that special purpose to general purpose, you now apply the standards, you suddenly realise that you are a large entity. My recommendation would be self-declaring to ASIC to at least go, look, we're really sorry, we've realised this, we're willing to restate comparatives, which you have to do anyway. So just have that conversation with them. The reason why I say the leasing standard has caused more entities to become large is because one of the thresholds for large is gross assets. So if you apply the leasing standard, you obviously bring on a right of use asset and you bring on lease liabilities. The threshold is not about net assets, it's about gross assets. So consequently, if you have substantial number of leases, or even if you just have a really big corporate lease for your head office, it will have given you a fairly big right of use asset, which means that that could have pushed you over the threshold. Moving away from ASIC a little bit, we're going to come back to them later on, but moving away a little bit, we're going to talk about an agenda decision. Now, before we do, I just want to give you a bit of an insight into what an agenda decision actually is. So as you can imagine, there are a significant number of entities who are applying our international standards in lots of jurisdictions. Anybody can put in a question to the International Interpretations Committee. So they kind of sit within the International Accounting Standards Board. And once the question is received by that committee, they generally send it out to the national standard setters to say, in your jurisdiction, do you see inconsistencies in this area? Do you think it's an issue? Do you think it's quite narrow scope? And then they get the answers back to that. The International Interpretations Committee can then do one of a few things. They can decide that this issue is a really big issue, and they can flick it up to the International Accounting Standards Board and say, you need to do something about the standard. They can issue an accounting interpretation. We don't have many of them, but we do have some. They can decide actually it's not a big deal at all, and therefore we're just not even going to do anything on it. Or they can do what we see most commonly, and they can issue an agenda decision. So an agenda decision is them saying, we are not going to put this on our agenda because we actually think the standards are clear. And in telling us that, they generally tell us what they think the answer is. Now, technical accountants like me understand and read these agenda decisions when they come out. Most other accountants are completely unaware that they exist until there is one that sets the cat amongst the pigeons. And this is one of those, hence why we're talking about it. It came out in April 2021, which was a little bit late for most of our June year ends. And since that date, we've had a huge amount more guidance around this. We've really started to see prevalence, what's been happening internationally around this. So the question that was asked, and what the committee do is they answer very clearly the question that was asked. They don't go off, they don't diverge. It's very clear the question that was asked. It's to do with software as a service. Now, a couple of years earlier, a question was asked to the committee around if I pay for access to a software that's hosted in the cloud, and we're going to use Excel in our example. So if we pay for access to Excel, what do we do with the costs? And the committee came back and said, you just expense them. It's not an intangible. So that wasn't controversial. So nobody knew about that one. So the follow on to that was this question, and it said, we know we have to expense the costs of accessing Excel. We get that. You told us that 2 years ago. However, what we've done this time is what we've used Excel to really try and tailor and give us a product that works really well for us. So now when we open Excel, it looks beautiful, and it's got all these different input things that come up, and we input the relevant information, and then it takes it and it sucks it behind the scenes, and it can present and give us reports in the way we want it. So we have configured or customized Excel, and we've spent a fair bit of money in doing that. Is that an intangible? And if it isn't, what is it? So that was the question that went through. I've turned the answer of the committee into a decision tree. They didn't give us a decision tree, but I've turned it into a decision tree. So let's have a look at that and see what the committee has told us. There are lots of questions in this decision tree. And as soon as we have lots of questions and as soon as we have lots of things that we have to answer and it will give us different results, it makes this much more difficult. It makes it much harder to think about. So let's work through these questions. I am not an IT person. So if anyone who's listening who is IT savvy, apologies for my lack of technical speak when we talk here. So the first question that we need to ask is this thing that we've done, this configuration or customization, does it actually result in an asset that we can control? Does it result in code that we can pull apart from Excel in our example, and we can unsell it without the other party having Excel? Does that code sit behind our firewall? Is it something that actually is an asset that really we do have created that would meet that definition? If we answer yes to that, we may have an intangible. It is deemed to be quite rare that would be the case, because generally the only way it works is if you've got, in our example, Excel, and we can't control Excel, we can't sell Excel. So therefore, even if we sold it onto somebody else, they need that other product. So generally we come down the right-hand side of this particular slide and we don't have an intangible. So the follow-up question to the committee was, if we don't have an intangible, well, what have we got? So the next question we need to ask is, who provided the service? Was the service provided, in our example, by Microsoft or by an agent of Microsoft? And if we answer no to that, then we just expense. As soon as the service is received, we have to expense it. If we answer yes, it was provided by Microsoft or an agent of Microsoft, the next question that we need to ask is, was that service distinct? Now you can see in that box, so I'm in the second box from the top, in the second box from the bottom, rather, in the middle, it talks about note 1. That's on the next slide, but we're going to come back to that. So what we're looking at when we talk about whether something is distinct is, for example, I had an old system. And what I've asked Microsoft to do is take all the information from that old system, suck it up, do whatever they need to do with it, and put it into my new beautifully configured Excel, so it will all work for me. That's a distinct service, because as soon as they've grabbed all of that information and popped it in the new system, it's done. I get the benefit of that. I don't need them to keep doing it, because all my new information is going into Excel. So if I say the service is distinct, you can see I end up in that expense box again. If I say it's not distinct, if I say it's ongoing, effectively Excel has done something behind the scenes that they've actually affected their code, or they've affected something that I benefit from the whole way through, then what I may have is a prepayment, because I probably paid for those services up front. I release that prepayment over the life that I think I am going to use Excel. So quite different answer from what we might currently be doing. What I've been seeing in a lot of entities is an intangible asset being recognised, and that intangible asset, in the vast majority of cases who have looked at this in great detail over the last 12 months, now has to be expensed. So we are seeing a huge amount of expensing going through. Generally, you can go take it through retained earnings, because what the committee has said is it's clear in the standards. So therefore, you have to go back. This is not a new standard. It does not have an effective date. It is effective immediately, because the committee are telling us that it was clear within the standard. So your to-do list item for this slide is, I want you to go and look at your balance sheets. I want you to look at your intangible assets, and if any of them are software related, I want you to have a think about, what's the software? Is it something internal that you've just created from scratch, or does it have to do with configuration or customization of something that sits in the cloud? And if it does, I want you to work through this decision tree and decide what the answer should be in relation to this. So let's have a look at this note 1 around whether the service is distinct. I suspect what will happen when you work through here is that you will circle certain things that say distinct, and you'll circle certain things that say not distinct. What you've got to do is just come down and say which one is more compelling. And as we know with our standards, they are principles based. You can end up on either side of the fence. You've just got to justify to me why you have landed on the side that you have. So again, something for you to work through with these particular intangible assets. So that's everything over the last 12 months. Now I'm going to pause there for a second, David, to see if we've had any questions on any of those or any comments you would like to make.
Thanks, Carmen. No questions have come through yet, but I've got a question just in relation to that case where there was the reversal of the impairment. One of our clients is a mining company that has been dormant for the last few years because they closed their mine a few years ago, but they've now decided to open it back up again, and they want to reverse the impairments on their mining equipment from a few years ago. So the timing of that, is that just a matter of when they make the decision to get it back up and running, that they can bring that back in?
Yeah, so what the standard says about reversal is we obviously have impairment indicators in the standard. If you're looking at you have impaired and you want to reverse it, you look at reversal indicators, which are the opposite way around of all the impairment indicators. So in your scenario, you've had a mine that you were going to stop. You're then looking to reinvigorate it. So potentially, yes, you have got that reversal when the decision has been made and it's sufficiently been made. It's not just, yeah, maybe we might do that at some point in the future. So they're actually looking that it's fairly confident. One of the complications with reversals, and I guess the difference between your example and the example of Oliver's, is Oliver's was within, I'm going to say, 12 to 18 month period where they impaired it and then they reversed it. The longer that time period is, it's more challenging, because what the standard says is you can't reverse the impairment above a certain amount that would have been if you hadn't had an impairment. So what I mean by that, and I'm going to attempt to do some mental arithmetic off the top of my head, is let's say that we had a piece of machinery worth, and it was $100,000 that you impaired. And let's say it had a remaining life of 10 years that we assessed at that date. And we did that impairment 4 years ago. We now think it's worth a value, but what we have to do is say, if we had not impaired it, what would it be sitting on in our books? So $100,000, 10-year life, 4 years of impairment, 4 years of depreciation would have given us a value of $60,000. So when we reverse the impairment, we can't take it above that $60,000 mark. Now, when you're doing that for lots of assets, and that's been that longer time frame, it's actually really quite painful to do that reversal of the impairment calculation. So absolutely, I think we will see a number of entities starting to do some of these reversals, either because of COVID or because the economy has changed, and some of those mines that potentially were uneconomical before, we might start having another go at them. So I think we'll start to see those reversals. It's just not as easy as possibly you think it is to do that reversal. Yeah,
okay, thanks.
No questions come through other than that one? We were talking, David. We were trying to get more questions coming through, but...
please send through your questions and I'll pass them on at the next break.
All right, fantastic. So let's have a look at what we need to look at right now at 30 June 2022. Now, internationally, the International Standards Board are very aware that they have given us massive amounts of work over the last few years with our leases, our revenue, and our financial instruments. So we are very much in a period of rest. It may not feel like it, but we are in a period of rest. So internationally, they haven't given us new standards. The only new standard is that fourth one down, which I will talk about. In Australia, as most of you hopefully are aware, if it is relevant to you, the AASB has been working on removing the reporting entity concept and changing the reporting framework within Australia. And the vast majority of the other standards on this slide are to do with that. So some of you, if you're already doing general purpose financial statements, the changes for you this year will be really minor. If you are doing special purpose financial statements, you may find that your changes are quite significant if you are having to move to general purpose. So it's very much it depends year. Some of you might have huge changes. Hopefully many of you really don't. So we are going to talk about the removal of special purpose. We're going to talk about the new tier 2 of general purpose reporting over the next few slides. But what I want to just cover on this slide is that fourth one down. It's the COVID related rent concessions. We've talked about this over the last couple of years, and this was a real concession that the International Board put through to try and make life easier for entities who had received a rent deferral or a rent waiver due to COVID. So what these standards said is they said, if you have received this deferral or a waiver from your landlord, don't worry about treating it as a modification, because that's really painful in the standards. What you can do is you can treat it like a variable lease payment. So you effectively just take it through the P&L. Made life so much easier. Every entity that I know who was affected by this early adopted it. So I suspect hopefully the majority of you did. The standards mandatory date was 30 June 22, which is why we've got it shown here. The one thing I do want to make you aware of, however, is whilst the mandatory date was 30 June 22, that is also the last date that it was applicable for any deferrals or waivers that were received. So if you had a deferral or a waiver that extends beyond 30 June 22, you are not able to use this concession. You will have to look at it as a modification of your lease, which will be much more work. Now, depending on which industry you're in, depending on where you are within Australia, some of you may still have these deferrals or waivers that extend beyond 30 June 22. So just wanted to make you aware of that. Whereas life has been very easy treating these over the last couple of years, from an accounting perspective, it will be made much more difficult for any concessions beyond 30 June 22. Now let's move on and look at our removal of special purpose. I am really hoping that this is not a surprise to anybody listening, because we have talked about this over the last couple of years and it's been included within the Bentleys newsletters over probably the last 2 or 3 years. The first thing I want to say is this is relevant for-profit private sector entities only. I still get a lot of questions, and I have still watched certain webinars and read certain publications that tell me that not-for-profits can no longer do special purpose. That is incorrect. Special purpose accounts are still applicable for not-for-profit entities if they have assessed themselves as a non-reporting entity. The removal of special purpose is applicable only for-profit private sector entities. And in fact, the name of the standard that removes it is called the Removal of Special Purpose Accounts for-profit private sector entities. So it couldn't be made any clearer within the standard, yet there is still some confusion in the not-for-profit space. So this particular slide is relevant for-profit private sector entities only. So let's start in my Start Here box. First thing we have to think about is legislation. What legislation are you as a for-profit entity subject to? And what does that legislation say? Does the legislation require you to prepare financial statements in accordance with Australian accounting standards or accounting standards? So let's think about some legislation you might apply. If you're a company, you're governed by the Corporations Act. Corporations Act requires certain entities to prepare financial statements in accordance with accounting standards. So that's our large proprietaries. That's our public companies greater than a certain size. It's our small foreign owned. It's our small companies who do crowdsourced funding. It's AFSLs, but I will come back to AFSLs. So bear with me if you are an AFSL. So any entity who is required to prepare financial statements in accordance with the Corporations Act is answering yes to that question, which pushes them straight along the bottom of the slide into general purpose financial statements from 30 June 22. There is no discussion, there is no greyness, there is no, I really don't think I have to. There's no, my owners and managers are the same people, nobody ever asks for them. It is very much a black and white answer. If legislation requires it, you are doing general purpose. So it's not just the Corps Act. The Corps Act is the easiest one to talk about because it's the most common one, but it is certainly not the only legislation that we need to think about. So let's assume that we answer no to that question and we move up into the next box. Does the entity have to comply with any documents? Now, what documents might you have to comply with? You might have a constitution, you might have a trust deed, you might have a joint venture agreement, a shareholder agreement, a purchase agreement, a sale agreement, a bank agreement. There is lots of documents you actually have to comply with. And do any of those documents require you to prepare financial statements in accordance with Australian accounting standards? You'll notice that in my first box, I talk about Australian accounting standards or accounting standards. And in my second box, I only talk about Australian accounting standards. That's deliberate. That is the wording within the standard. And the reason that the board did that is because the Corporations Act uses the terminology accounting standards. So they had to expand it in that first box. But predominantly what the board is trying to do is protect the brand name of Australian accounting standards. So consequently, if your document only says prepare financial statements in accordance with generally accepted accounting principles, you're not in. If it just says in accordance with accounting standards, you're not in. It has to say preparation of financial statements in accordance with Australian accounting standards. So if we say no, I've looked at all the documents, none of them requires me to prepare financial statements in accordance with Australian accounting standards, then we go along the top of the slide. Do whatever you're doing. Keep preparing special purpose if you want. And if there's no legislation and no other document telling you to prepare financials, then really prepare the financials that suit the needs of the users that you do have. So suit the needs of the owners, suit the needs of the bank, whatever you are being asked to do. If that's cash accounting, great, go for your life. Let's come back to our yes. We've looked at our documents, and yes, there is a sentence in there that requires us to prepare financial statements in accordance with Australian accounting standards. The next question we need to ask is in that purple box. Was that document created or amended after the 1st of July 2021? If we say no, it wasn't, it's actually an old document, it's been around forever and a day and nobody ever looks at it, then we answer no to that question and you can continue to prepare special purpose financial statements. The standard includes a bit of a grandfathering provision for you. There may be some extra disclosures that you will need to include, particularly around recognition and measurement criteria within the standards, but otherwise you can keep doing special purpose. If we say yes, it was. The document was either created after the 1st of July or we put an amendment in and we didn't take out that sentence in the orangey box, then you will have to do general purpose financial statements. So it is very black and white now. There is no judgment, there is no discretion. It also doesn't matter what type of entity you are. If you are a for-profit private sector entity, regardless of whether you are a trust, a company, whatever else you might be, you have to consider these criteria from 30 June 2022. So we now know who has to do general purpose. What does general purpose look like? We have two tiers of general purpose financial reports, and we've had two tiers for a while. However, tier 2 has now changed. Tier 1 is our full IFRS accounts. So effectively, this is for entities who are publicly accountable. And what we mean by that is entities who are listed, and for the purpose of this part of the session, I'm just going to call them financial institutions. So they're deemed to be publicly accountable. And the reason that they have to do our tier 1 is because if you imagine you're a listed entity and you want to operate in the global capital markets, and I'm an investor from the UK, and I pick up your listed financials and I read that they comply with Australian accounting standards. I go, well, that's great, got no idea what they mean. I'm going to put them down and I'm going to pick up another set of financials that I actually understand how they've been put together. Whereas if I pick them up as a UK investor and see that they comply with Australian accounting standards, which means full compliance with international financial reporting standards, well, I now know what that means. And I'm going to then explore this company because maybe it is a company I want to invest in. So that's the idea of tier 1 is principally to enable our entities to participate in the global capital markets. If you are required to do general purpose financial statements and you are not publicly accountable, you are looking to do tier 2. You can always opt up, but my recommendation is you'd be in that tier 2. Our tier 2 used to be called reduced disclosure requirements, so RDR. Now, this applies both to the for-profits and the not-for-profits who are listening. If any of you are currently preparing RDR financial statements, you cannot do that from 30 June 2022. That framework does not exist. So we have to switch our framework. What our new tier 2 is called the simplified disclosure requirements, or simplified disclosure standards, simplified disclosures. They're all interchangeable. The difference between our old RDR and our simplified disclosures is where our presentation and disclosure requirements sit. So the way that it used to work is we used all the recognition and measurement criteria from all the relevant standards. We consolidated and equity accounted from those standards. But then under RDR, we would still stay in those standards. And what we would do is we'd look for the shaded bits, and those bits that were shaded, we could ignore them. That wasn't a disclosure we were required. To be honest, it was a little bit painful to do that. Now, under our new simplified disclosures, what we do is we look, for example, if we want property, plant and equipment, we're in ASB 116 and we get all our recognition and measurement from there. Soon as we get to the section called presentation and disclosure, we jump out of that standard and we jump into the standard ASB 1060. This is a brand new standard. It is effective for the first time at 30 June 22. And what it is a big disclosure checklist. So all of the disclosures, presentation and disclosure requirements that you need if you are doing tier 2 are in that standard. So if you want to know, okay, property, plant and equipment, what are my relevant disclosures? You look in the contents, you look at the section called property, plant and equipment, and you go to that section, and that tells you all your disclosures. It is based on IFRS for SMEs, which is an international standard. It is probably one of the most plain English standards that we have. So 1060 consequently is much easier to read in many ways than some of our other standards. So instead of jumping through looking for shading, 1060 is our standard for presentation and disclosure. If you look at the difference between RDR and simplified disclosure, it's not a huge difference. Some areas there is less disclosures. There are a couple of areas where there is more. For example, under the new tier 2, we are required to disclose audit fees and we are required to disclose imputation credits because we were told as a board that the users found that information really helpful. So there are 2 tiers. So let's explore a little bit more around this area. And I've been alluding to the fact I'm going to talk about AFSLs. Now is that time. So an AFSL is an Australian financial service license holder. So anybody who is offering financial advice, etc., needs one of these licenses. Now, we have been talking for the last 2 years to say that the FS70 form, which is the form that requires these AFSL holders to submit financial statements, is going to be revised to require general purpose financial statements from 30 June 22. So any AFSL who has listened to any technical person over the last 2 years hopefully has been planning for that and preparing for that, because that's very much what we have been telling you. Up until about 12 days ago, when ASIC released a media release. To be honest, ASIC have been incredibly slow at releasing guidance on this. So there has been conversations with ASIC for the last 2 years where they have confirmed that absolutely these forms will be updated and general purpose will be required from 30 June 22. In the media release that they released, and again, I've got that reference number for you, they have created, to be honest, a whole world of complication. So what I'm going to talk to you about is what is known. I was in a discussion group last week, which was convened by ASIC and had probably 15 technical accountants in there. I'm fairly certain that most of us who left that meeting were none the wiser on what ASIC's intention was after that meeting, which is a bit of a worry. So we are expecting and hoping that more guidance is going to be released, because at the moment it is incredibly confusing the way that they've worded it. And in fact, there may be, because of their wording, a breach of accounting standards, which could result in qualifications of audit reports. So ASIC have kind of had to go back to the drawing board a little bit to work out what is going to happen in these areas. So let's have a look at what they've actually said. So the way that, sorry, can we just go back a slide, Joe? Thank you. So the way that AFSL works is if you have a license, you are registered under Chapter 7 of the Corporations Act. If you are a corporate, you may also be covered by Chapter 2M. So if you are a large proprietary who is also providing financial services, you will be required to be under both Chapter 2M and Chapter 7. So what ASIC have said is if you are one of those entities, you have to do general purpose financial statements from 30 June 22 because you've had plenty of time. You knew that 2M was going to require it. If you report under Chapter 7 only, ASIC have given you a transition year. So ASIC have said that you can continue to provide special purpose financial statements at 30 June 22, so long as those financial statements comply with all recognition and measurement requirements. Now, in their view, you should be doing that anyway. I am aware there are a number of AFSLs who lodge special purpose accounts who do not comply with recognition and measurement. But from 30 June 22, you are able to do that. And then from 30 June 23, you are in general purpose land. What they've said around which tier. So we've just talked on the last slide about the 2 tiers of general purpose financials. Tier 1, I simplified it on the last slide, but effectively tier 1 is for listeds, or the definition from the standard is entities who hold assets in a fiduciary capacity for a broad group of outsiders. And what ASIC mean by that is if you are holding client monies. So the first thing you need to do if you are an AFSL holder is you need to look at that tier 1 definition and say, do I fit within this? And if you do, you are preparing tier 1 financial statements. If you don't, the next thing you need to do is look and see if you are one of these entities on the next slide. ASIC have said, yes, we've got that tier 1 definition. However, we are deeming that each of these entities is also required to do tier 1 financial statements. So I think there's 12 around this particular circle. If you are one of these, you do not have a choice. You have to do tier 1 financial statements. Now, this is where we start getting complexities around the transition rules, because some of them you're able to still do tier 2 for the first year because you've only just found out you had to do tier 1 20 days before the year end. But going forward, ASIC expect every one of these entities to be doing full general purpose, full tier 1 financial statements, which is not necessarily what these entities were planning on doing. So that's where we sit on AFSLs. As I said, it is not easy at this point in time because the ASIC media release has probably confused rather than helped. But fingers crossed we will see more guidance. If you review something that has been put out by any of the bodies or any other reading that you see on this, just be aware that there is probably more guidance coming. So don't take what is in there as absolute gospel. Just keep your eye out and make sure with the source of that, you really want to be looking at things that have been put out by ASIC, because that is where we can really heavily rely on that. So actually, I should just check, David, was there any questions on any of that move to special purpose? Move to general purpose, not move to special purpose.
Yeah, just a question on the AFSL and that ASIC media release. So are they saying that they're deferring the requirement to go to tier 1, so you have to do tier 2, or are they saying that you can still do special purpose?
So if you are Chapter 7 only, you can do special purpose for 30 June 22. The rules around if you're meant to be tier 1, can you do tier 2, start getting a bit grey and a bit complicated depending on whether you are a real publicly accountable entity under the definition of the standard, or whether you are one of those deemed entities that we've just seen on the last slide.
Yeah, okay. I think some of our AFSL smaller clients will appreciate another year.
Yes, yep. Fantastic. All right, so let's move on and see. Those of you who attended the sessions last year might remember that I told you about a project that I was working on with the SSB to look at not-for-profit revenue and not-for-profit income. And I put out a bit of a, if anyone's interested in helping, because we were really interested in hearing, particularly from preparers, about issues that they had seen in trying to implement these new standards. That project that I was working on has now finished because it was very short-term, narrow scope. But I just wanted to give the not-for-profits listening a little bit of an update on some of the material that is out there. As part of this project, we issued a new staff FAQ. Now, that staff FAQ deals with the scope of the standards. So what effectively is, it's a big decision tree. And it starts off that says, is the income arising from rent? And if you answer yes, it tells you that you're in AASB 16. Is the income arising from interest and dividends? Yes, tells you you're in AASB 9. So it kind of works its way down and knocks out a lot of the income and points you to a different standard. And then you're left with the bits that could be in 15 or 1058. May be helpful in some scenarios for you. The next thing that was issued is a key facts document. Now, this principally was written for non-financial people. And the idea behind it is because as part of the discussions with stakeholders, we heard a lot that it was really hard to try and explain this to non-financial people, particularly boards or donors. And they had no idea what the standards meant. They had no idea why the finance people were getting so caught up in the wording in grant agreements. So this key facts document is a real high-level review of the two standards, the difference between the two, how you get within one, how you get within the other, and what the impact of that is. So it may be useful for you to read as finance people, but predominantly the audience is for your non-financial stakeholders. The third outcome from this project has been an additional example included within AASB 15 for not-for-profits. So there was a staff FAQ that dealt with upfront fees for private schools. But what we heard is a lot of entities said, well, that's not relevant to me. I'm not a private school. It was relevant. It was equally relevant to everybody. But to avoid that confusion about whether they should look at it or not, there is a generic example that has been written that deals with upfront fees. So it deals with the principles, it deals with what we need to look at, it deals with the thought process that you will need to go through. And that's been put within AASB 15 in the appendix for not-for-profits. The last output that the AASB has done is they have issued a webinar. That webinar includes a lot of the issues that were raised with the board, and it doesn't necessarily save the world, but it definitely gives some guidance on where to look, point some signposts about if you're having issues with this particular topic, here's where some guidance might be. So that is all available on the AASB website. I believe the webinars are also available on the AASB YouTube channel. I don't know how to find that, but apparently it's on there. And I also believe that there may be 2 webinars because we sold out the first one, so we had to record another one. They are pretty much identical. I don't present with notes. I present half of the webinar. So they're as identical as I can get them without any notes. So you don't need to listen to 3 hours worth of webinars. Just pick one of them and listen to it. It's about an hour and a half for you to think about. The next thing that has been done in this particular topic is a post-implementation review. So 2 years after a standard's issued, standard setters do a post-implementation review. And the idea of that review is that the board says, okay, this is what we intended this standard to do. Has it done it? And what are the issues and what do we need to do? That post-implementation review has started at 2022. So it is in the process of being commencing. So the board are currently, or the staff are currently put together a document. Given how many issues were raised during the project I did, we've already got a great starting point. We've got a lot of these issues that we are aware of, but the staff are desperate to hear from preparers, particularly of not-for-profit accounts. If you are particularly passionate about this, even if all you want to do is to moan at somebody for 15 minutes about how horrible these 2 standards are as you've implemented them, staff would love to hear from you, because it is our opportunity. I think it is acknowledged that these standards are not working the way that we thought they would when we issued them. So it's our opportunity to try and get them more right than they are. So if you are interested in getting involved, doesn't need to be a formal written letter. It can be a discussion. There will also be round tables if you want to attend. Either get in touch with your Bentleys contact or get in touch with me directly, and I will pass all details on to the staff. So the AASB staff will then be able to contact you. The one last thing that did come out of this particular project is to do with our concessionary leases. So this is something that I'm super excited we actually finally got through. So those of you in the not-for-profit space would be aware that when these standards were first issued, so 1058, what it said effectively was if you had a concessionary lease, and by that I mean a lease that you are paying significantly below fair value, what it said you had to do was fair value that right to use asset. Back in 2018, the board released a standard that provided a temporary exemption for that. So said that you could value your right of use asset at cost. Cost was based on the lease liability. Since 2018, every time I've had a discussion with not-for-profit or every time I presented to not-for-profits, there's generally been a question that said, when is this temporary exemption going to be lifted? Because it is a massive amount of work for us and we need to know whether we need to plan it. The great news I can tell you is that exception is not going to be lifted. It has effectively been made permanent within the standards for all concessionary leases. So there was discussion, it was only going to be existing ones. It is all concessionary leases. So therefore, you do not need to worry about fair valuing your right of use asset. And hopefully that will remove a huge amount of angst for a lot of not-for-profits. I do want to remind you that there are disclosures that exist for any concessionary leases that you do have. So please don't forget that we need to include those. So we're back to ASIC. What else have ASIC been doing? So ASIC have released their focus areas for the year. Surprisingly, asset values or impairment is number 2, not number 1, and always generally number one. But the reason that they've dropped it down this year is they've introduced a new section called Uncertainties and Risks. Now, behind each of these is a huge amount of information. So what I would encourage everybody to do, whether they are governed by ASIC or not, is to really explore some of these focus areas. Because again, we've got a corporate regulator telling us these are the areas that we are going to focus on. These are the areas where we think errors might occur. These are the areas that directors should be focusing on. So therefore, you should be providing this at a directors meeting, at an audit and finance committee meeting, and make sure they're discussing it. So within our uncertainties and risks, and I'm just going to talk through each of them at a high level. What ASIC have effectively said is we are in a really weird world at the moment, and it seems to be almost every day new things happen. So they've given us, I think there's about 12 different scenarios to think about. And they range from the conflict in the Ukraine to changing consumer preferences, to COVID restrictions, to staff shortages, to supply chain issues. So there's lots of these things that are occurring, and lots of these areas where boards will need to think, how does this flow through to our financial statements? And maybe it doesn't, but maybe we need to update our risk register because we haven't done that for a while. And from a governance perspective, we need to be considering these. So I think that one particular is a really important document that all people in the position of governance, regardless of the entity type, should be looking at. The next one is to do with our asset values. So very similar to what we saw when we looked at those misstatements. It's to do with impairment, and ASIC are reminding us, make sure that our assumptions are reasonable, make sure we've looked at deferred tax assets, make sure we've looked at goodwill, make sure we've thought about any reversals that we might want to put through. So very similar to what we've had previously when we look at this. Third one is to do with provisions. Now, again, we saw in our restatements that we had some information about rehabilitation provisions. What we're looking at here is ASIC have reminded us about those rehabilitation provisions, but they've also reminded us of a couple of others. They've said that in this current economic climate, you may find that some of the contracts that you have become onerous, i.e. it is costing us more money to do the contract than we're going to earn from it. If that is the case, you are required to put through an onerous contract provision. The other type of provisions they've asked us to consider is financial guarantees. So often what we've seen in the past, particularly when things are going well, is we issue financial guarantees to everybody within our group and we're all good. And we may have been all good a few years ago, but if our subsidiaries or other entities we've given that guarantee to, it's not necessarily performing as well as we thought it would. Potentially, that guarantee could crystallise into a liability. So have we considered that? Do we need a provision to recognise that actually we now have a liability, not just a contingency? Number 4, subsequent events. I think this one is ASIC saying, far out, who knows what's going to happen next. And over the last couple of years, we've had some major things that have happened in that July-August period, predominantly to do with COVID. So they've just reminded us that don't forget we need to consider that. So our subsequent events kicks in from 30 June, or our reporting date, up until the date the financials are signed for issue. If I was to speak to a room full of auditors, they tell me that they've got a really detailed process for checking subsequent events. They do some work at the audit, they do more work just before the accounts are signed. When I speak to preparers and say, what do you do? How do you identify these subsequent events? Not so robust a process. Yet it is the preparers who are the ones who are going to have to do the work in this area. So I'm just encouraging you to just keep your eyes and ears open and maybe make sure that you've just got that regular check-in with the CEO, the GM, the board, whoever it is, to be aware, is there anything that needs to be disclosed or adjusted in the financial statements? Remember, we have 2 types of events. We have the adjusting events, which are the ones that involve lots of work because we have to change the numbers, or we have the non-adjusting events, which is where we disclose only. Number 5 is our disclosure section. Now, ASIC has gone crazy in this section. It breaks up into lots of different things. They've asked us to consider half-year review disclosures. They've asked us to review disclosures in the operating and financial review. They've asked us to look at estimates, judgments, and assumptions. They've asked us to make sure that our financial reports include specific, relevant information. Material information. Stop putting lots of immaterial stuff in there, which just declutters clutters the financial statements. Your disclosures are about telling me the story. So if I read your financial statements, I should know your story of your financial position and your performance. I don't need huge amounts of descriptive stuff about things that are irrelevant or things that aren't important to the core of the story. So make sure that you take that step back and you read your financial statements. Now is a great time to do that. Read last year's. You will probably be surprised how much is in there that you can easily get rid of without actually removing any of the core messages, because often we don't do that. And when we get into that detail of doing it and that chaos of year end, we don't have time to actually say, how can we improve this particular document? In our other matters section, what ASIC have included in there is certain information about registered schemes. They've included a reminder about off-balance sheet transactions. So are we consolidating everything we should be? And bed licenses. So in the aged care space, have we reviewed appropriately the useful life of those particular licenses? Because they are going to cease from 2024. So a fair bit of work to look at in this particular section, but absolutely encouraging you all to look at these focus areas. So what else? ACNC, we're staying with the regulators, but moving to the not-for-profit space. So with the ACNC, hopefully you are aware that they have increased the financial reporting thresholds for registered charities. So our small charities are now those with revenue less than 500,000, and our large charities are those with revenue greater than 3 million. So the only difference between them is whether you have to prepare a financial report. So if you've moved from medium to small, you may not have to. And if you've moved from large to medium, you can choose to have a review rather than an audit. They are all minimum. There is nothing stopping you doing a financial report if you don't need to. There's nothing stopping you having an audit if you don't need to. The other thing that the ACNC has done this year is introduce the requirement to disclose key management personnel remuneration. So if you are a large charity, so we've just seen that's revenue greater than 3 million, and you are preparing special purpose financial statements, you are required to effectively comply with the standards in relation to KMP remuneration. So you can see on the slide, they've given us some guidance around who they are and what that means. Comparatives are not required in year one. They will be required going forward, but they're not required in year one. In addition, the ACNC has given an exemption if the charity has only one remunerated KMP. So if your board is voluntary and the only key management personnel that you have who is remunerated is your GM, then you don't need to disclose their salary, because it seems to be a little unfair that their salary is completely disclosed. When you are looking at these disclosures, you can choose to use the disclosure requirements in 124 or in AASB 1060. My strong recommendation is you use 1060 because it's more easily worded, it's all together, it's much easier to find. So don't forget that from 30 June 22, large charities preparing special purpose do need to disclose this remuneration. I just wanted to raise a particularly contemporary issue, and when we were looking at doing this session, it's an area that I've received probably more queries on over the last 12 months than I have since I started my own business however many years ago. And I just wanted to remind entities, particularly now because we've got more entities moving to general purpose, that how you account for your investments needs to be looked at on a regular basis. We have seen a number of investments move across these different categories, particularly during COVID, because we've had situations where entities have had to throw more money into an investment in order to keep them alive, and probably have got benefit from that, often in respect of voting rights. So I'm going to work from the left-hand side to the right-hand side of the slide. The first type of investments are our passive investments. So this is where we might have a small investment in a listed entity or an unlisted investment. We don't have significant influence. We don't have control. What we do is we treat this investment as like it's a financial instrument, and we have to measure it at fair value. There is no cost exemption. So all of my passive investments under the standard have to be at fair value. And that can be challenging to try and determine what that fair value is. The next type of investment is my associate, and this is where we have significant influence, and you can see the definition of significant influence is shown there on the slide. Some things I want you to think about. The standard talks about 20% voting interest, prima facie is significant influence. It may be that it isn't, and it may be that you have significant influence below that, but that's our general line. If you have the ability to appoint a director, it's generally deemed that you have significant influence. So I want you to think about within your investment portfolio, do you have the right to appoint a director? Even if you choose not to use that right, if you have the right, you probably have an associate. A joint arrangement is where we have joint control. So David and I have set up a particular arrangement. And what we're looking at is, do we both have the right to block the decisions of the other party? So David wants to do something and I say, not a chance. I slam my fist on the table and go, you can't do it because I've said no. And we both need to agree. And vice versa. If I want to do something, he gets to slam his fist on the table and says no chance, because we both have to agree. So if both parties or multiple parties can block the decisions of everyone, and everybody has to be in agreement for it to happen, we've got joint control. If we have joint control, we're looking at a joint arrangement, and we then determine whether it's a joint venture or a joint operation. The last thing that we're looking at is our subsidiaries. So a subsidiary is where we have control within our own right. Now, people really want bright lines. People really want numbers. They want to say it's got to be at least 50%. It doesn't. That doesn't exist for a subsidiary. What we're looking at to have control is, do we meet three criteria? Firstly, do I have power? Secondly, do I have exposure to variable returns? And thirdly, can I affect the returns because of the power that I've got, regardless of my shareholding? So we can have control in our own right if we only had a 30% interest, depending on who the other parties are, depending on what rights I've got. So I just want you to think about, as I say, your investment portfolio, and just make sure that we understand that everything is in the right, I was going to say box, but they're more circles. Everything is in the right circle that we are looking at in respect of this. So I've given you a fair amount to look at the current financial reporting period. And again, David, that's a good time for me to have a drink of tea and to ask you if you've got any questions.
Thanks, Carmen. Still no questions from our guests. So again, if you've got any questions, this is a great opportunity to pose them direct to Carmen and get her thoughts and feedback. Just one question again from me, Carmen. Just with the changing in the ACNC thresholds, I know a lot of registered entities are also incorporated associations subject to state-based legislation. Am I right in saying that the ACNC rules override the Associations and Corporations Act, and that if the thresholds have moved such that they are now perhaps a medium or small, that is what they are rather than perhaps what they would be under their state-based legislation?
Yes, I'm going to give a different answer depending on where in Australia you are located. The answer to your question is yes, the ACNC rules are the relevant ones for every state and territory except Queensland. If you are in Queensland, you have to deal with your state rules as well as the ACNC. The ACNC are hoping that they get Queensland on board soon, but at this point there's a difference between Queensland and every other jurisdiction within Australia. So yes, ACNC are the ones you need to follow. Assuming you're registered with the ACNC, obviously. Yeah.
Great. And I guess obviously they need to check with their own constitution to see whether they are bound to still have an audit, perhaps.
Yes. Yes. Yeah.
Okay, thanks.
So let's have a look forward. Let's give you some more items for your to-do list. So we've talked about key management personnel remuneration for 30 June 22. The ACNC are then expanding that from 30 June 23. So what they want you to disclose then is all related party transactions, so not just the KMP disclosures. We are expecting more guidance around this. So it talks, for example, about material related party transactions only. Now, when I studied, we learned that all related party transactions were material by nature, but kind of moved away from that a little bit. If it's a transaction that it could occur with anybody and it's just occurred because with a related party, possibly that doesn't need to be disclosed, but we are waiting for more guidance. So let's have a look on what we have to do depending on what type of entity we are. If we are a small charity, I just have to give a brief description of the transaction in the annual information statement because I don't put in financial statements. Again, we don't know what that brief description is. We're not sure exactly what they mean. If I'm a medium or large charity and they've been grouped together, we have to comply with either AASB 124 or AASB 1060. As I mentioned before, I would be choosing 1060 because it is simpler, everything's in one place, and you don't need to worry about hunting through the actual standard 124. In addition, there is a summary of transactions required in the AIS. So the really important thing to remember is even though this isn't valid until 30th of June 23, it is applicable for the year beginning 1st of July 22, which is what, 10 days time or something. So consequently, have you got a process in place to be capturing all this information that could happen, or all these transactions that could happen in that period? Particularly any key management personnel related transactions, because if you have a change in key management personnel during the year, it is much easier to capture all of that information from them from the beginning of the year until the date they leave, rather than trying to chase them down at 30th of June. So I would be encouraging all charities to make sure you have a process in place to identify these related party transactions. So have a look at it whilst we are waiting for more guidance. There is some guidance on the ACNC website, but please don't wait before you start capturing this information. So I wanted to finish off my session with just looking at a couple of topics that I'm starting to see a lot more than I used to. And when I start seeing it a lot more, it generally means it becomes much more prevalent over the next 6 to 12 months. The first one is one that I really wanted to keep my head buried in the sand because I was quite happy knowing nothing about crypto assets. Unfortunately, however, given the number of queries I'm getting on this, I think we're going to see this becoming much more prevalent. Whenever I present on this topic in a face-to-face scenario, there's very much a divide in the room between the people who are of a certain age and the people who are below a certain age. And the people who are below a certain age, this is normal to them. I have a 17-year-old son, and this was normal. Lots of his friends have invested in crypto, and lots of my friends who have teenage 20-year-old children have invested in this. Whereas The parents, not necessarily so much. I read something that's between 18 and 44-year-olds. There's about 1 million people have invested in these cryptos within Australia. So it's a massive number. Given the falls over the last few weeks, it'll be interesting to see what happens, but it's certainly been something that we've seen an increase in popularity. Where I'm seeing that flow through to entities is if you are wanting to engage with the millennials, the Gen Zs, whatever you want to call them, and they are investing in this, we've seen more entities who are looking to try and accept payment in some type of crypto. Now, if you're accepting the payment in the crypto, that means you end up with the crypto. And what do I do with it? So there is no explicit guidance in the standards around this. And to be honest, there probably won't be. The International Board looked to putting this on their agenda, but by the time the International Board get around to issuing a standard, we've probably moved on and we've developed the next thing. So what they're doing is looking at some of the standards and seeing whether they're still fit for purpose in this space and whether any additional guidance could be developed, but it won't be explicitly crypto. So if you've got crypto holdings that you have, the accounting for them, as I say, is not explicitly listed anywhere in the standards. We talked about an agenda decision earlier. There was an agenda decision back in 2019, and that was actually based on a AASB paper that was issued. And what that said predominantly is you are most likely going to end up with your crypto being held as an intangible asset. If it's held as an intangible asset, the standard says we can hold intangibles at cost, or it also says that if there is an active market, you can hold it at fair value. Now, traditionally, we have said that within Australia, there is no intangible that has an active market. However, if I'm looking at something like a Bitcoin or an Ethereum, there's over $1 billion worth of trades on those in a 24-hour period. Fairly certain that's probably an active market. So therefore, our thinking on intangibles may need to be changed. There are a significant number of cryptocurrencies, and not all of them have $1 billion of trades every 24 months. There's some that might have $10 worth of trades. So where do I draw that line between an active market and a non-active market? Judgment call. Could have very different answers whether I hold things at cost or at fair value. Depending on why I'm holding my crypto, I might decide that I'm actually holding it for inventory because I'm holding it to sell. If I deem myself a broker trader, so I'm buying and selling this crypto to trade it, well, potentially I can hold it at fair value. Otherwise, I'm holding my inventory at cost. Back in 2019, the guidance that came out said that generally we wouldn't expect any of this crypto to meet the definition of a financial asset or a cash equivalent. There probably is certainly one currency now that most people would agree is probably a cash equivalent, because we have something called the USDC, so the US dollar coin, and it's a cryptocurrency, but it is pegged to the US dollar and it's fully collateralized. So effectively, every time one USDC is issued, a dollar is put into, I like to think of it as a big vault, and we have it in there. And at any point in time, my USDC can be handed in and exchanged for proper US dollars. So it's probably the only currency at this point in time that we think probably could meet the definition of a cash equivalent. However, we're also fully aware that some of the reserve banks in a number of jurisdictions are looking at issuing their own crypto. Quite possibly we would see those. So what my key message is, if you are holding any of this crypto or thinking of holding any of it, please think very carefully about the accounting implication of this, because it may not give you the answer that you think you might have. The next type of query I'm getting is even more entering into the weird and wonderful space of crypto. And these are entities who are minting their own coins or minting their own tokens. So the real challenge around that is, what's the cost? How much did it cost me to create this thing that's really imaginary and I'm holding out my hand as if there's something in there? It's not, because it doesn't exist. And what's the performance obligation? So if I sell you a token, what am I agreeing to give you back for that token? Because remember, in accordance with the revenue standard, it's all about promises and performance obligations, and I can't recognise the revenue until I've completed those. So there's been some interesting discussions about revenue recognition. And what if these tokens aren't ever handed back in, aren't ever redeemed? What if they're being used for investment purposes? So this space, I think potentially we will start seeing more and more discussions around it. But if you are planning on entering it, please make sure that you understand the accounting before you do that. The last thing that I want to talk about, which leads me beautifully into Emma's discussion that who's coming up next, is around sustainability standards. So again, not an area that we have any explicit guidance within the accounting standards. Back in November, there was the COP26 in Glasgow, and during that conference, there was an International Sustainability Standards Board, or ISSB, that was established. Now, that board sits within the IFRS Foundation, so it's got the same standing as the International Accounting Standards Board, the International Auditing Board, so it's got credibility. I've said already today that standards boards generally move quite slowly. This board, however, is on lightning speed. So it was established in November last year, March 2022 even, they issued their first 2 exposure drafts. So those 2 exposure drafts have been issued in Australia by the Australian Accounting Standards Board. So they are the body that is going to look at this point in time. And they've issued a wraparound standard, a wraparound exposure draft, which effectively says these are the 2 international exposure drafts. We're really interested in what your thoughts are in Australia. Will this conflict with anything that you are currently doing? Do you think that this should be issued in Australia? Do you think it should be mandatory? If so, who to? And what would be the effective date? So let's have a look at what those 2 exposure drafts require. They are both around disclosures. So the first considers the concept of enterprise value, not a concept that we generally talk about within our accounting standards. So it says, think about everything in this sustainability space. Which of those risks could affect the value of your entity, and disclose that. Now, as accountants, when we prepare financial statements, we're not very good at coming up with our own words. We really like to copy words from a model account or copy it from something else. You won't be able to in this, because it is very much what do you do in your business? Where are you located? And what will affect your entity? Not what will affect one of your competitors, what will affect your entity. The next exposure draft, S2, specifically deals with climate-related disclosures. So in particularly disclosure of scope 1, 2 and 3 greenhouse gases. And then it's actually a really long exposure draft, because at the back, it's got lots of information about sectors and industries. So if I'm in this industry, I'm required to disclose this. If I'm in this industry, I'm required to disclose this. The international comment period ends at the end of July. The SSB comment period ends on the 15th of July, purely to give them time to put their own comment letter in. This is an area that will receive much more prevalence. The standards for these 2 are expected to be issued before the end of the year. The ISSB is not issuing mandatory standards. They are leaving that up to each jurisdiction. And that's why it's so important for the SSB to understand what we think should happen within Australia. The SSB has held a number of round tables. I don't know if they've all finished. I suspect they may well have done. So hopefully some of you got a chance to participate in that. The SSB are meeting tomorrow and on Thursday, and it is on the agenda of the SSB tomorrow to talk about some of these, the feedback on this particular exposure draft. So if it is an area you are particularly interested in, I understand you can register on the SSB website to attend. It's virtual for the public, so anybody can dial in, and the agenda is on there. But please encourage you to get involved and comment on this particular topic, because I think that we will see much more prevalence. And even though it may not be issued as mandatory, it almost by best practice might become mandatory. So David, that was all I had to talk about. So happy if any questions have come through, or any further questions or comments you might have.
Thank you, Carmen. Still no questions in the Q&A box, so obviously a very comprehensive presentation. But if there are any questions, just type them in now, and I'll relay them to Carmen. Certainly a lot of interesting topics there, Carmen, around particularly the crypto assets and some of this emerging sustainability disclosure. It's certainly only going to get more and more, yeah, certainly that how you account for cryptocurrency is quite an interesting topic. I know I've only ever seen it in super funds, which have to value it at market value, so that's sort of reasonably clear cut. But again, I don't know how you should do it in a different entity, I guess. Certainly I see it as investments. That seems to be how people have it, but yeah, I guess the accounting standards need to catch up.
Yep.
Okay, there are no further questions, so thank you very much, Carmen. As I said, very comprehensive session. We're very fortunate that we've got an expert such as yourself to provide that update, and so hopefully everyone has been brought up to speed with the latest developments around financial reporting. And if you do have any questions about any of those topics, speak to your Bentleys advisor, and obviously Carmen's available if it's a bit meatier that we need to get some proper advice around. So thanks again, Carmen, really appreciate that presentation. Our next presenter is also an expert in her field. Emma Peters is a special counsel with Cowell Clarke Commercial Lawyers, based here in Adelaide, where I am as well. Emma's specialty relates to compliance and strategy pertaining to environmental, social and governance matters, with particular expertise regarding modern slavery compliance, bribery and corruption, whistleblowing and sustainability. Emma has been working with one of my colleagues, David Papper, particularly around modern slavery and statements and also assurance, and several Bentleys partners are also registering as effectively carbon auditors, because we can see that that's certainly going to be a demand in the future from our clients. So thanks, Emma. If you can, take us away.
Great, thank you very much for the intro. So I have the task of running through ESG in about 25 minutes. It's a pretty big topic, so I'll just try and give a few headliners for you today and a few considerations. Ideally, a few things that you can take away. So maybe next slide, thanks. So what I'm going to try and touch on a little bit about today is what actually is ESG, what are the drivers behind it, and then a few call outs along the way. ESG is a really big space. So on the screen, I've listed just a few different areas that come within the bucket of ESG, but in reality, there can be 110 of these metrics that go into the broad ESG compliance framework. So that's what I'm going to try and break down to in 25 minutes. I'll delve into a little bit about each of the different pillars of ESG, so the environment, social and governance components. But just really in the big picture, what ESG really is looking at the social constraints in which an entity operates. So this is definitely getting a huge amount of traction. A lot of organisations and individuals are talking about this. So I guess the question is, for entities, is what is relevant to them and what to do next. So in reality, you might think, well, why is ESG relevant for my organisations? I could be a not-for-profit, or I could be, a smaller entity that doesn't have this type of resourcing to look at this. You might go, well, it's really only relevant for, say, high polluters. But in reality, what we're seeing is that it has incredibly broad application, and it's relevant for every entity, no matter what your structure is. Last week, I was at an ESG summit, so we spent the whole day just talking about ESG, and what the message that was really coming out of that is that we're now at the point where ESG strategies and frameworks, goals, should just be business as usual. So it just should be part of the way that you're operating day to day. So what ESG really focuses on is looking at the long-term value of an organisation. So we're looking beyond perhaps immediate decision making to having this broader emphasis of stakeholders. So stakeholders in the ESG world is quite broad. So if we think of a traditional stakeholder, it may be, say, for a listed entity, your shareholders, very obvious stakeholder. But ESG looks at stakeholders from shareholders through to employees, consumers, and the community in which an entity operates. So very broad, and I often get asked the question, who is it that I actually report to? Because it feels so broad. So the focus that I take is really looking at managing risk. The market is changing very quickly. What's emphasised in ESG also changes quickly. So it's also responding to changes in risk and mitigating risk across environmental, social and governance. So soon we really see it that ESG compliance is really going to be a matter of when, not if, regulation will increase. Some of my clients take the view that it's better to be a little bit prepared in this space given the breadth of compliance rather than being reactionary and caught behind the eight ball. So I guess just to paint that picture of regulation, in Australia at the moment, there's currently no single ESG regulation framework. That obviously makes it really hard for organisations to know what to prioritise and what to comply with in reality. It's really this piecemeal compliance framework. So if I was to rattle off a few different legislative compliance frameworks that we have, it's, say, the Modern Slavery Act. If we look at bribery and corruption, that's criminalised under the Criminal Code. We obviously have the Fair Work Act. But then if we delve into environmental compliance, that differs across each state. Major emitters, they have to report in accordance with the National Greenhouse and Energy Reporting Act. And then if you were to look at it from a diversity perspective, non-public sector employees with 100 more employees need to report under the Workplace Gender Equality Agency Act. So that's a lot to take in for organisations to know where they need to comply. But I think that paints the picture of we do have ESG compliance, it's just really patchy. If we're to look globally, Australia is a bit behind. So if we look at the global framework, there are mandatory ESG disclosures to differing extents in different countries. So if we look at the UK, New Zealand, US, Singapore, Hong Kong, India, these countries have all are in the process or have introduced mandatory disclosures regarding ESG. In the EU, they're taking this a bit further and looking at introducing corporate sustainability reporting and also mandatory supply chain due diligence and examinations. And as Carmen mentioned earlier, post COP26, it was also announced that there's going to be an international sustainability board. So they're going to develop a comprehensive global baseline of sustainability disclosures, which will help a lot of organisations to know where they should be sitting in terms of disclosures. So what's really anticipated is that in Australia, we tend to be a few years behind on the legislative front. We tend to sit back, watch what the global community is doing, and then we follow suit. So the general consensus is that it's coming and to be prepared for it to come. So the legislation aside, we're really seeing this almost meteoric rise in ESG compliance for different reasons and drivers. And there's a number of reasons why we see organisations doing this. So the private sector is moving incredibly quickly. So this might be driven by a range of factors from consumer demands through to employee retention expectations. Reputation is a really big one, and also competition and shareholder activism. We also see that filtering down. So, for instance, with tenders, we're often now seeing ESG questions being built into the tender process. So it might be questions around, supply chain transparency or emissions or environmental contraventions. They are all different types of ESG questions that we're getting seen being asked in tenders. A few stats. So in 2021, it's reported that around 52% of boards report that ESG is just a regular agenda item. That's certainly only increasing. From a workplace perspective, by 2029, it's estimated about 72% of the workforce will be comprised Gen Z and millennials. This generation certainly is bringing a different values system to work, and they're showing a lot of concern for environmental and social matters. So from a retention perspective, we're definitely seeing it being linked in that way. From a competition perspective, we're almost seeing this race to the top. So you might see an organisation say, make an announcement, we're going to be net zero by X date, and then you see others in that sector seem to follow suit. So that competition and reputational edge is definitely having an impact on this driver going forward. From a legal perspective, I probably can't help myself being a lawyer, but it's definitely been pulled into legal frameworks as well. So when we think about director duties, ESG is being really linked into those traditional director duties like care, skill, and due diligence. For instance, the obligation on a director to consider the climate in decision making has been linked into a director duty. The other area we're seeing become really hot is misleading and deceptive conduct. So, for instance, announcements around sustainability, is a product or a good truly sustainable? That links into the traditional misleading and deceptive conduct. And then from a litigious perspective, we're definitely seeing ESG litigation grow, which I'll talk to in a bit. But then in the M&A context, ESG due diligence is just becoming part of the norm. So in our traditional DD process, asking ESG questions and requests for information. So as I mentioned earlier, misleading and deceptive conduct is becoming a real big area that ACCC has announced that this year they will be really cracking down on what's known as greenwashing. So greenwashing is where you make something sound greener or better than in reality it really is. That is a form of deception. So typically when the ACCC does an investigation, they'll wait for a complaint. So a complaint from, say, the public, this is misleading, then they investigate. The ACCC has actually announced that they'll be going out and looking at what organisations are doing. So a really simple example is if an organisation has made an announcement that will be carbon neutral or net zero by a certain date, they'll want to see publicly what that organisation is doing to support that claim. So the data that's supporting that claim to reach that goal. From a litigious perspective, the first greenwashing litigation has commenced here in Australia. So that's where, in terms of something being disclosed to be green, and then shareholders saying, well, is that good actually green? So really, the landscape is changing. What entities publicly disclose, you actually need to make sure that you're meeting those disclosure requirements. From a finance perspective, we're definitely seeing things like loans being linked into sustainability and green loans, and then also just the beginning of the impact on insurance. So that's some of the trends and drivers behind ESG. What I'll quickly do is just delve into each of the pillars of ESG. What I'll start with is environment, particularly because environment is just such a hot topic at the moment, especially post-election. So as you may have heard, there's been announcements around Australia reducing emissions by 43% by 2030. What that will mean is that we need to rapidly increase the rate in which we are reducing emissions, and we're going to see that filter down onto the private sector as is happening today. So like I said, environment is a really broad concept, so it considers things from climate change to waste, energy, biodiversity. what I'll talk a little bit about is just that climate change aspect, because historically we might have thought when we think what this is relevant for, it is those really big polluting activities. So thinking, that burning of fossil fuels, the release of methane from the livestock industry and things like fertilizers. But now the emphasis is really on that all organisations have a footprint and they contribute to climate change. So there's this pressure coming down on organisations looking at what they're doing and this broad focus on reducing greenhouse gas emissions. So as I mentioned earlier, internationally, definitely a lot of pressure on organisations in light of things like the Paris Agreement to be looking at their different, at their footprint. We have a really patchy framework here in Australia for environmental compliance, and particularly around the disclosure requirements. As I mentioned earlier, some reporting already for really big emitters under the National Greenhouse and Energy Reporting Scheme. We expect that to be really expanded out and mandatory disclosures to be coming into play for a wide range of organisations. So when we look at organisations who are setting goals around reducing being carbon neutral or reducing their carbon emissions, what is really important to start with is actually knowing, well, what is it that you want to achieve? What's your goal? And to do that, you really need to understand what is our baseline. So to do that, we break emissions into different scopes. So scope 1, 2, and 3. So what scope 1 is, that is an entity's direct emissions. So that is the direct emissions from owned or controlled sources. Scope 2 is indirect emissions. So that is from things like the generation of purchased energy and the consumption of energy. That can be things like heating and cooling, for instance. So office, think heating or cooling your office. Scope 3 is everything else. So that's your indirect emissions. That's not included in scope 1 or scope 2. That's looking at your entire value chain. So when you look at your value chain, it could be suppliers. They are producing or have a footprint producing emissions that gets counted as part of your overall footprint. So it's estimated that for most organisations, this is just an estimation, that about 80 to 90% of emissions are actually scope 3. But scope 3 is also the hardest to measure in reality because it's beyond your control. So now that we know what kind of constitutes your footprint, what we see is there's often a lot of announcements around we're carbon neutral or we're net zero. There's actually quite a big difference between carbon neutral and net zero, and this is one of the areas that the ACCC is going to be really hot on, is because I could announce, but tomorrow I'll be carbon neutral. So what that means is I am offsetting my emissions so that I'll be neutral. So for every 1 tonne of carbon that it's emitted, you'll be buying carbon credits, which are also known as ACCUs on the Australian carbon market, for instance, or you might invest in a greenhouse gas reduction project. So you'll be buying credits to reduce your footprint. The risk is here, and what the ACCC is really looking at is that can be a concept known as greenwashing. So although you've announced that you're carbon neutral, you actually haven't reduced emissions. You've just spent a lot of money and bought a lot of offsets. Net zero is a little bit different because what that is looking at is a more holistic approach. So that's actually reducing greenhouse gas emissions, and then to the extent that you can't reduce, you offset. So every organisation will have a tail end that you can't completely reduce, that you'll offset to some extent. So that's looking at all your scopes, including scope 3, and then considering ways to reduce. So just call out, if your organisation is looking at this space and making an announcement, a couple of takeaways is if you do make an announcement, making sure you can actually meet that and have data to support it, but then also be careful in the way that you're announcing that goal. So how do organisations really respond to this environment and this changing framework? There's a few different risk areas. So from an economic risk, we're definitely seeing with the transition to kind of net zero policy and regulation changes. And like I said, that potential introduction of mandatory emission reporting. But we're also seeing it from like a contractual perspective. So things like reporting requirements around your emissions being contractually brought in. Litigation risk is a big area, so potentially contractual disputes and claims related to climate-related events. Think about your traditional force majeure, but also climate-related nuisance and negligence claims. From a due diligence perspective, we're seeing from an ESG perspective, a lot of questions in a sale environment around potential reputational risk from an environmental perspective, and then also from this tender and risk perspective. So I have some clients that have, as part of their overall tender framework, the organisations that can disclose their footprint will be upgraded or downgraded. So multitude of reasons why you may want to start looking into this area if you haven't already. So that's my little snapshot on the environmental component of ESG. There's two other parts, the social and the governance. So with all this focus being on the environment, I guess one message also is don't forget the S and the G. The S is really focusing on the how and the why of ESG. So this is really how an organisation relates to people. In my mind, simplified, I think there's 4 key areas of social. So we're looking at staff, supply chain, safety, and community. The staff aspect is really looking at diversity and training, retention, safety. Hopefully everyone here is always already looking into that, but that's a safe workplace, but also how you measure and track a safe workplace. Supply chain is all about the safety of suppliers, payment of suppliers, modern slavery risk, and then the community is human rights risks and the relationships in which an entity operates. So within the S, there's generally different risk tolerances. So something like health and safety, I would suggest should be low risk. So there should be not a lot of tolerance to people getting injured in the workplace. Whereas if we look at modern slavery, that's a different risk question of, is there risk in a third party or in your organisation, and how do you mitigate that risk? So a few takeaways of what to look out for with the S. Safety, as I mentioned, is always there and should always be considered. Modern slavery, I'll speak to a little bit in a moment because there's a few updates there. But another one, supply chain transparency. So actually knowing where the goods come from that you use in your organisation. So with some potential changes that will be introduced, there's a concept that's been contemplated around getting warranties around the goods and services that are imported into Australia. So if there is high risk provinces or locations for, say, forced labour or modern slavery, that there would be comfort around those goods and whether there's any connection to forced labour. So that kind of brings into these systems and processes an organisation has to identify risk down your supply chain. Data is always a big one. So the security of your data, but then also the risk management of that data. So having a system in place to identify potential data breaches, but then how to respond to a data breach and when to report that data breach. So having something in place like a data breach response plan is quite key there, so that you can respond and meet your the requirements to, say, report in 2 days, depending on the harm that may have occurred. Another area is sanctions. So sanctions are increasing at a rapid rate. If we think about the war in Ukraine and then all the Russian sanctions. So this is where an organisation knowing, is there any risk of me say, engaging with a sanctioned entity or person, and then also from a bribery and corruption perspective, identifying potential political exposure, high risk of bribery and corruption. So if we follow suit with the EU, there will be this importance placed on mandatory human rights due diligence, and for entities, they should really be thinking about what is the system and process that I have in place for due diligence on the third parties that I engage with. From a reputational perspective, we're definitely seeing organisations who don't do well in this space almost been having a bit in that places like the AFR. So there's definitely that reputational risk of a connection with forced labour in the goods that may be being produced. So from a governance perspective, the governance really underpins the E and the S. So this is really looking at systems, processes, reporting, the structure of an organisation, so from board composition and diversity through to the exec composition and remuneration. So are the things like the policies and procedures that an organisation have in place, are they actually effective? Are they being followed? Is it more than a piece of paper and the policy is truly being actioned? I think it's worth noting that there are now organisations out there that rank entities on their ESG performance. So I could type the name of any entity I want in a database that we have access to, and it will essentially bring up immediate results as to ESG compliance. So that's usually based on information that's publicly disclosed by an entity, say a website, that helps rank those entities. So a lot of businesses actually don't know that that's available, but that is a tool that we use, and we also use it as part of our due diligence. And as I mentioned earlier, just from a director perspective, we're really seeing this being linked into directors' duties, so that typical care, skill, diligence, it's really broadening out for what directors need to be considering. So I think I've done a bit of a snapshot, hopefully, of what ESG is. I just wanted to give a few updates, and lastly on modern slavery. We in Australia have the Modern Slavery Act, which commenced in 2019, been around for a few years now, and it is currently under review. But so what modern slavery is the worst form of exploitation of people. So think about things like, sweatshops, child labour, debt bondage, where you have people working for insane hours in unsafe conditions with hardly any remuneration. So the Modern Slavery Act is trying to enforce entities to have an understanding of what are the risks in their organisation in modern slavery, but also what are the risks down the supply chain. So the Act is a national reporting requirement. What entities that need to report do is lodge an annual modern slavery statement. That statement is placed into a register. It's a public register, so anyone can look up the statements. And that register is really being used for lots of organisations to look at it, but also from like a competition type perspective as well. So who's required to report? Essentially what it is, entities with 100 million consolidated revenue. That's an Australian entity or a foreign entity that carries on business in Australia. It applies to a really wide range of entities, so from listed entities through to not-for-profits. As long as you're over that financial threshold, you're in the bucket and you're a reporting entity. What we're seeing in reality too is that we're really seeing the compliance burden really being pushed down the supply chain a bit. So if you want to do business maybe with a larger organisation who is a reporting entity, you might need to answer certain questions or provide comfort to that organisation. We do the following to identify risks in our supply chain of modern slavery or in our organisation. So it can be for entities under that reporting threshold, that there needs to be a few basic things in place to identify potential risks to do business with those larger organisations. To lodge an effective modern slavery statement, there is mandatory reporting criteria. So there's 7 mandatory reporting criteria. It looks pretty simple on the face of it, but we actually see in reality some organisations not quite hitting that criteria. So for instance, describing the risks of modern slavery in the operations and supply chain, what that requires is analysis the entire way down a supply chain. So a simple example, if you have a uniform, you need to know where the cotton comes from that goes into that uniform. The rest of the criteria are really looking at things like showing that you're actually doing something like due diligence to find modern slavery. But then also the 5th criteria is assessing the effectiveness of those actions. So looking back and going, is our system and process that's in place really working or not? Those entities that are doing really well in this space are also getting some external assurance, so auditing in regard to their frameworks as well. So at the moment, what happens if an entity doesn't comply? It's a name and shame regime. We see often in forums like the AFR, entities being ranked or disclosed about they're not doing a very good job. There was also a report recently done by the Australian Human Rights Law Commission that went through certain high-risk sectors and then ranked entities for their compliance, and there was a bit of fallout from that publication. My big update is that the Act is currently under review. What they're looking at is things like the financial threshold for reporting, so potentially bringing down that financial threshold, but also the introduction, and this is what gets most people's attention, the introduction of penalties for non-compliance. So that penalty regime would be looking at initially those who don't lodge a statement, but then also those who lodge a defective statement. There's also a lot of analysis being done on certain high-risk countries and locations and getting warranties and publications around goods, as I mentioned earlier, imported from those locations. So keep an eye out on this space. If you're already a reporting entity, be mindful of potential penalties coming in, and if you're not, whether you may be pulled into that regime. So just to finish off, we've been working a bit with Bentleys because ESG is a lot about data and managing that data and due diligence. So there's certain ways that we can help automate some of that work. If you want to talk a little bit more about how tech might assist you with that, feel free to reach out to Bentleys or myself. But if you have any questions or you're not sure, often I get the question, where do I even start my ESG journey for our organisations? Feel free to reach out. So thank you.
Thank you very much, Emma. A lot to take in there. We don't have any questions that have come through, but I suspect it's a matter of so much information, it's hard to know where to start with all of this, but hopefully that's given everybody a bit of a high level understanding of what ESG is. And like you said, it's as much about reputational risk as opposed to any regulatory or financial requirements, and things like tenders. It's again sort of one of those questions that's starting to be asked, so I think everyone needs to be across it. So thank you very much. If anyone does have any questions about this, again, please speak to your Bentleys contact, and obviously if it's a more in-depth question, we can pass you on to Emma, who's obviously all across this. So thanks again, Emma, for that update. And thanks to everybody for your attendance. I hope you found it useful, and we'd be keen to get your feedback. There will be an email coming out in the following week with a copy of the presentation and also a feedback form. Thanks for joining us today. Stay safe and well, and on behalf of all of my Bentleys colleagues, we look forward to seeing you soon. Thank you.